All right. Hey, everyone, and welcome to the Masari AMA, hosted obviously by Messari. During this session, Messari founder and CEO Ryan Selkis will be speaking with three of Masari's analysts. They'll be chatting about the multi-chain future, or more like, we're in it right now, the multi-chain present. Plus, they'll be giving you some insight on how they keep up with the torrent of chain updates. And of course, I'll be facilitating the attendee Q&A and making sure these guys answer your questions as well. So I'm Bailey Reitzel. I'm a longtime crypto journalist and all-around media professional. My work has appeared in most of the crypto-specific publications and has also been featured on The Atlantic, The Economist, and on CNBC. I've worked on some of the biggest tech companies and crypto companies in the world, and I've recently also started doing conference builds. So working on the Masari Mainnet conference build as well. So as I said, I'll be your link to the panelists today. Thanks to those who have already asked questions. I will make sure that those get answered. But for those who haven't and are interested, here's how you can engage with us. So you can utilize a couple Crowdcast features on the bottom right of your screen. Keep an eye on the chat box, as I'm going to drop some helpful links to the attendees in there. For instance, these Crowdcasts are also acting as a sneak peek inside the future setting sessions that we'll be hosting at Mainnet 2021. That's coming up September 20th through 22nd in person in New York City. So if you want to dive deeper into any of these topics, you can go ahead and grab a pass to Mainnet 2021 right now, or right after this. I'll drop a link into the chat that allows you to sign up for Mainnet 2021 and gives you a $450 discount for that pass. All right. Next, if you want to ask a question to the panelists, if you go ahead and use the Q&A box that, again, you see at the bottom right, it says ask a question. So use that. Other attendees can upvote those, and we'll ask, in case we get stuck on time, we'll ask the most upvoted questions from there. All right, so that's that. I'll go ahead and get into the meat of this. Like I said, today your host is Ryan Selkis, the founder and CEO of Masari, and the other panelists are Ryan Watkins, Mason Nystrom, and Roberto Talamas. So Ryan, go ahead and take it away.
Thank you, Bailey. And for those tuning in that have done a Crowdcast or two with us in the past, welcome back. It's been a while. And it's been a wild year so far. We're looking forward to seeing people in person for the first time in 2 years at Masari's Mainnet coming up in just a few weeks here. As Bailey said, if you have questions, I will be monitoring the questions as well. So either she or I will pop in 4 questions for our panelists. But I have an obvious one and something that I think can warm us up round robin, since we have some experts across Layer 1, NFTs, Web3 assets, DeFi assets, currencies themselves. There's now 95 coins with market caps over $1 billion, as Gabe points out. Thank you, Gabe. We are in a multi-coin future already, a multi-chain future already. Does that number make you queasy, or is it different this time? TM. Who wants to take a crack at it?
Yeah. So there's definitely not 95 projects that are worth more than $1 billion. I mean, that's what the market's selling right now, but there's certainly not 95 projects that are worth that much. So let's kick off with that. That being said, for sure, like there are going to be many projects that will be successful and multi-chain future. It's not like it's the future; it literally is now. I mean, even if it was just Bitcoin and Ethereum, that's already a multi-chain future, and I don't think there's any likely to change anytime soon.
I think I'll add to that is we've seen, at least in this round, with the explosion of DeFi, an easy way to look at fundamentals of this protocol. So there's a clear contrast between what you could see in 2018, 2017 to now, where you can actually track the revenue and the fees that this protocol is generating. So I think there's a huge difference there.
There are at least 96 projects, because CryptoPunk's market cap is over $1 billion. So there's another one for you. But I agree with Watkins that there are definitely some overvalued assets in the space, and then obviously some that are vastly undervalued.
I don't think you can put everything in the same bucket or paint everything with a broad brush. So how do, I know how we as a company think about sectors and breaking down different assets throughout our product, but Do you want to kind of go individually down the different sectors that you predominantly cover, and just talk about what you look at as drivers of value or things that might actually make sense from a quote unquote fundamentals standpoint? Because arguably we're still so early, and the space is based on memetics that values in the eye of the beholder still, and we're kind of in that like very earliest stage. So maybe. Roberto, I'll give you the hardest one in cryptocurrencies, and I'll let you go last because that's arguably the hardest one from a fundamental standpoint. But maybe Mason, you can talk about Web3 assets and NFTs, and then Watkins, you could talk about DeFi.
Yeah, absolutely. So from the Web3 perspective, it's really interesting because you get a lot of application-specific blockchains, so stuff like Helium, and for the most part, you have to either track the supply side demand, whether that's spinning up nodes, or if it's a marketplace looking at, where's the demand, where's the supply, and tracking those individual user metrics. And that can be relatively challenging just depending on the type of Web3 application you're looking at, because you have something like the graph that could be fairly technical. And now you have to see how many different subgraphs there are and which ones people are actually using and indexing. From the NFT perspective, it's a little different because there's so much more different facets. You can look at an individual NFT project, or you can look at a generalized marketplace like SuperRare, OpenSea, or Rarible. And those have much more tangible metrics in terms of volume that you can track, users, unique holders, and stuff like that.
Watkins, there's two components to DeFi valuations.
Yeah.
There's farmed tokens, and then there's fees. How much of that is real?
Yeah, so I think just in general, when I approach it's like fundamental analysis for any sector within this industry, I always try to start with like, what type of asset is this? And what that means is that, like, am I looking at something that is more commodity-like? Am I looking at something that is more money-like? Or am I looking at something that is more like equity or bond-like, right? Something that's like producing income. So that's like the basic framework. I think that basic framework is not well understood, which is why some of these assets already trade on like memetics and narratives, and it's just beauty and eyes of the beholder, because people don't have that basic starting point of like, what the hell is this thing? But once you have that, then we can start to dive into specifics. So in DeFi, like many of the assets are equity, like they have some kind of governance power, and they have some kind of right to the economics of a network. So for that, you could definitely look at almost any of the metrics that you typically look at for a business, like how fast it's growing, like what are revenues like, what are margins like, typically things I look at. Then also there's like these weird crypto native kind of things that you look at, like community. And that's one of those things that I think it's like almost like a buzzword that people throw out, or at least it sounds like it, but it's like real, right? Because in the long run, the communities will be driving the majority of value for these networks. And on top of that, communities, I think, drive the network effects of these projects as well, right? So it's no different than, like say like an Uber or any of the other networks that have been successful over the past decade or two. So those are some of the basic starting points that I usually start off with.
Last but not least, Roberto, you got the hard one.
Sure.
Yeah,
I got the hard one. I think it's still up in the air, I think, but it is, as Watkins was mentioning, it's first, how do you analyze, how do you categorize these assets like commodity, capital producing assets, and like an equity like a bond. So I think the theory right now, the general theory is that you treat currencies as sort of like a commodity, and you value them based on what Chris Bernanke popularized, like MV equals PQ. And apart from that, I just haven't seen any other more robust valuation framework for a currency, besides just like the value that it has, that like in the economy that it supports.
I'll follow up with you on the currency side, because we have to talk about ETH. And Bitcoin versus ETH, how people are thinking about that as a capital asset versus money. you've all written about this in some way, shape, or form over the course of the last 6 months. How has your thesis kind of changed, and how do you think about how Bitcoin and Ethereum play off of each other, if at all?
Is that just a question for the panel, or?
Yeah,
I think that's a good question for Watkins.
One of
Thank you, Watkins.
Yeah.
Yeah, so Watkins, you go first, and then the other two will have, because they were afraid to go first, they will have to disagree with you in some way or clarify what you...
Watkins the one that wrote an 84 pager in Ethereum. Like, it's, of course, they're kind of
I'm actually a USD maximalist.
After reading it, I'm sure you thoroughly rebutted point
by
point,
sure.
Roberto. So you're on deck.
Absolutely.
Watkins.
Yeah, that's why I think when I first joined Masari, so I definitely wasn't a Bitcoin maximalist, but I was also very skeptical of ETH's value accrual long term. I think that was actually the consensus, is that Ethereum would be a very valuable platform, but like, what is this asset, right? Like, okay, I guess you can value it based off the fees, but it's not like the store value like asset like Bitcoin, and the store value like sector, at least at the time, I thought it was likely to be like power law distribution, right? So Bitcoin would get 80, 90% of the market, and Ethereum would get, I don't know, maybe 10%, if anything. I think what's changed is that, I think first, and once again, this is tracking just my own evolution, how I thought of it, is the first thing I noticed is economic activity on Ethereum starting to pick up. And specifically, like the transaction volumes for ETH and different use cases for ETH start to pick up as well. So ETH starting to be used as a medium exchange, like more often. ETH starting to be used as a store of value more often in DeFi, as a unit of count in NFTs, right? So people pricing NFTs and starting to pay for it. And this activity started to like explode over the past year and a half. And to me, it started to signal that ETH was becoming a lot more money-like than I originally thought. And I think fundamentally money is and has always been a network. So you need like ways to like use an asset as money in order for it to become money. And Ethereum is, to me, by far the leader in building this kind of network, which is money. So that's kind of been the thesis for Ethereum. And I think I think now we get into like Ethereum versus Bitcoin. So I always joke that Bitcoin has been like a pet rock. It's just something that just kind of sits there and does nothing. And that's exactly what it's supposed to be, right? It's supposed to be this thing that just doesn't change, that you don't need to worry about at all. Like you literally could leave it under mattress, quote unquote, and it's the same thing 10 years from now. But that being said, I think Bitcoin's, the community's like reluctance to embrace interoperability with the rest of the crypto economy, I think will actually start to, or is actually like is inhibiting its growth as a money-like asset, because I think there's a much larger hurdle to gain adoption as a money in the physical world, right? Like getting Bitcoin being used as a payment mechanism for whatever it may be in like the real world, than it is to get Bitcoin to be money in this virtual reality we're creating. Right, so getting it to be used to buy like NFTs, getting it to be used to buy land in like a metaverse or whatever it may be. And I think that's where Ethereum is definitely leading the charge, and I don't see that changing anytime soon. So that's kind of how I see the Ethereum versus Bitcoin thesis. So I guess definitely can coexist. Definitely neither going away anytime soon, but but that is what informs my thesis on Ethereum versus Bitcoin.
From my part, I'm always skeptical of companies, protocols, assets trying to be everything to everybody. And I'm curious, Mason, Roberto, to get your take on Arthur Hayes from BitMEX, who had I think a really good comparison between Bitcoin and Ethereum. And it was actually outlining the bull case for Ethereum, comparing M0 of the US dollar to the market cap of the large cap tech companies, and they're about 3 trillion each. So his general gist was, if Bitcoin wins the M0 game and Ethereum wins the big tech game, they're still going to be mostly at par with each other, and they will be so different that both will succeed or fail, on their own merits. Does that argument, is that compelling? Is that like an interesting way to think about it? Because I could make an argument that in an interoperable world, wrapped Bitcoin on Ethereum is going to be better hard money than ETH because it's used for gas and it's used for staking and there are so many other reasons to use it versus just USDC or just wrapped Bitcoin or whatever the currency is. And so if these blockchains are interoperable as they've been historically, you could very well have something like Bitcoin, probably Bitcoin, but something like it be the money chain and settlement chain for hard money, and then Ethereum just become this financial internet, which is a plenty big opportunity. How have you thought about that for valuing the two?
I would agree with a lot of that. I think that kind of the bull case for Bitcoin, as I see it, is becoming this reserve asset across different blockchains. And so whether that's wrapped Bitcoin, whether that's any other bridge that will exist in the future, I think that can bring a lot of value. And Bitcoin is always going to be the kind of most secure asset that people think, oh, like I'm totally fine keeping my money in this, like it's a inflation resistant or inflation hedge, or however you want to look at it from like a macro perspective. And so I think that narrative will continue to proliferate. And whether like Ethereum sees like a dominant portion of like wrapped Bitcoin on it, I think that could be great for Ethereum in the long run. I've actually been surprised that Ethereum has become like a store of value asset amongst DeFi protocols. The fact that like NFTs are priced in ETH to me sometimes makes no sense when you would much rather have some sort of like USDC or US dollar denominated value.
I think I agree with most of that as well. And in terms of the bull case for Bitcoin too, I come from a traditional finance where in 2017, Bitcoin was seen as a speculative thing. And now when I speak to my previous colleagues, you start to see this shift towards adding Bitcoin or having some sort of Bitcoin exposure as a replacement to gold itself. So I think when you start onboarding this humongous asset managers from the traditional world, and they start adding and allocating a portion of their portfolios to Bitcoin as a replacement for gold, you start to see some bull case for Bitcoin. In terms of the economic activity, I think Ethereum, like Watkins said, is leading the charge there, and it's been something that's happened over the past year and a half with the boom of DeFi and now the boom of NFT. So when you look at just the economic activity on the chain, I think Ethereum is leading the way on that end.
So I think I'll add a quick skeptic's take on Bitcoin becoming the reserve currency of multiple chains. For one, there's no dominant interoperability standard. I think there's unlikely to be a dominant interoperability standard anytime soon. So you'll have this kind of patchwork of different ways of getting Bitcoin on different chains. And each way, because of the fact that Bitcoin is not expressive enough, that you can't like really build like robust layer 2s on top of it, you will always be adding new security assumptions to Bitcoin if you put on these different chains, right? So you will actually not get the benefits of even if it was true that Bitcoin was going to continue to be the most secure network in the world, which I don't think is necessarily a foregone conclusion, right? We may find that proof of stake is actually far more secure than proof of work. You wouldn't be even getting the benefit of that on these different chains, right? Because it's really different. In which case, you probably want to just go with like the native asset on whatever blockchain is expressive enough and actually provides you like the security to actually interact with these different protocols without introducing these new trust assumptions from these third-party chains. So I guess that's where like the interoperability thesis for Bitcoin, I think I'm a little bit skeptical of. And then I think finally on the institutional side, I think people are learning very fast, right? They start with Bitcoin, or they start skeptical, they get into Bitcoin, and then all of a sudden 6 months later they're piling into ETH, right? Like so. Really quick, and then also like even months later they're piling into like ETH competitors, right? So and I think like people who come into this industry now they're much less ideological than the people who were first here, and they have much less concern over like the history of this industry and how important Bitcoin or Ethereum is. They're just looking objectively. And I think for a lot of people, it's much easier to understand why something that is growing incredibly fast and being used more, like Ethereum, is probably going to be valuable than something that doesn't do anything, right? And then I think and the last thing I'd say is the digital gold comparison, I think is a little bit less attractive now because of the fact that gold has just not performed well over the past decade in this environment where we had the financial crisis and we had COVID, two events that should have been extremely bullish for gold, and this thing literally was like pet rock and didn't do anything. So I guess that's where I'd probably slightly be skeptical of like this Bitcoin interoperability thesis. But yeah.
Well, a couple of things here, Mr. Watkins. One of the reasons that gold did not do well is because digital gold was born and ate its lunch over the last decade, number one. Number two, when it comes to interoperability, the fact that Bitcoin isn't as expressive as Ethereum, I don't think really matters. It's not rocket science to do a two-way peg and do periodic transfers of assets across chains. We've been doing it for years with Wrap Bitcoin and TBTC and some of the other pegged assets that have made their way over to Ethereum. And I don't think that would be overly difficult if it is the single integration point that Bitcoin has with many other blockchains. Agreed, it's probably going to be quite a while, if ever, that you get far beyond that in terms of complexity or how much smart contract development is built on Bitcoin, regardless of what some folks in the Bitcoin community might have you believe. That doesn't necessarily take away from the money argument. Now the question becomes, can Ethereum continue to lock in all that value into its platform as the financial internet, or are we going to see some more leakage or application-specific chains? Will more throughput go onto blockchains like Solana, Polkadots, Cosmos, Power Chains, etc.? How do you think about ETH2 and specifically how value will accrue across either kind of layer 2 chains, other shards of the Ethereum blockchain, which ultimately might look not too dissimilar from other smart contract platforms altogether in terms of how they're interoperating with each other? How do you kind of break those three segments down?
Yeah, so I guess I could start here. I guess as far as like the value leakage from Ethereum to other competitors, I think just a kind of a broader question about kind of like what this multi-chain future looks like. And I definitely agree there will be value leakage over the coming years. And part of that is just because as an Ethereum will lose market share. I think probably part of this is just because a lot of these different chains are starting from a smaller base, so they're going to be growing faster and they'll be gaining market share in that respect. And then part of it as well is that there is just simply not, Ethereum cannot do everything. Like you said, right? There are certain use cases that might be better optimized for a blockchain that is like specifically designed to do this one thing. And for those use cases, I think they will be on application-specific blockchains, or they might even be on like some general purpose blockchains, like say Solana, that are optimized for maybe doing something better than Ethereum, like speed and like lower latency, right? So maybe you'll have like those like use cases beyond Solana. And then there's like that competition with like the different layer 2s. And right now, I think, at least for Ethereum, while Ethereum is very far along in its development, its scaling roadmap is still probably in a similar stage to many of these other different blockchains. So there is a big window of opportunity for people to figure this out, right? And if we're Ethereum right now, it is kind of like a patchwork of these different solutions. Like there's these side chains, there's optimistic rollups, there's ZK rollups. It's just a whole bunch of different things, and no one knows how it's going to play out. And on top of that, because no one knows how it's going to play out, it's also difficult to understand like the value accrual for like these different layer 2s versus the layer 1, right? Like how much will fees be alleviated on L1, and as a result, like how much fees will be available to stakers, or I guess ETH holders, because we have EIP 1559 and most of that will be burned. So it's really going to everyone, not just like stakers. And I guess that's unclear. So that's why to me, like I really do think that like the Ethereum as a money thesis is something that is almost necessary for Ethereum to continue to accrue value, at least at these levels where this thing is worth almost $500 billion. Because if it's a case where a lot of the fees pressure gets alleviated and a lot of activity does move to L2s, then maybe it's not producing enough fees for it to justify a multi-trillion-dollar valuation off the fee basis alone. Yeah, I guess that's where I see it now.
Yeah, I think the direct value accrual of L2 networks and sidechains is a little vague, and I think we'll see that play out over the next 6 months in terms of what magnitude of value accrual actually transfers to ETH. But I'm under the thesis that any increased utility or adoption of Ethereum, even at the L2 level, will benefit Ethereum in the long run.
The one thing that I point out from this conversation is that at least during this year, we saw the rise of all these sidechains that were essentially just like a copy paste of Ethereum, right? BSC and at the beginning in maybe February, and then later on Polygon came out in May. And when you start looking at the dominance of Ethereum in TVL percentage, you saw that dominance decrease from about 90% to like 76, 75%. What's interesting to hear is that you have other chains like Solana, like Watkins was talking about, and I'm still not sure if you're going to see some leakage going from Ethereum to these chains, purely because the development toolkit in some of these chains is completely different from Ethereum. So you have these new entrants that have quantitative backgrounds, software engineering backgrounds. They're going direct to Solana, for example, and they're learning Rust, and they're not like spending time learning Solidity. So I do think that in the long run, we might see some side chains that take away a little bit of Ethereum dominance, but then you also have these other chains that require a different toolkit, a different skill set that are required to build that ecosystem. So I think in that sense, both would be able to coexist a little more.
Roberto, you want to elaborate a little bit on the pros and cons of TVL? That we had a question directed here to Watkins, who tweeted about this yesterday, but maybe you first, and then Watkins elaborate on that.
Sure. The issue with with TVL here is that it's very sensitive to price. So you can see the amount of TVL. TVL, by the way, is total value locked, and it's just a measure to see how much money is locked in smart contract platforms or smart contracts in general. And the big caveat with this metric, as I mentioned earlier, is that it's very sensitive to the price of a token. So when you see TVL going up, it might not mean that there's more money in these smart contract platforms. It just means that the price is appreciated over a period of time, which shows an increase in TVL, which could be a little bit misleading. And Watkins, you want to add anything else to that?
Yeah. So let's say a couple things here. I think for one, like so the meaning of TVL depends on the sector that the protocol is in, and also how the protocol actually accrues value. So let's just take like lending protocols, for example. What is the TVL for a lending protocol, like say Compound? Well, for the way it's computed there is it's the difference between the amount of deposits and then the amount of outstanding loans, right? So that's called the TVL. That number is actually meaningless, right? If you're trying to understand like a lending protocol, like I don't care how many deposits are just sitting there idly. I care about how much deposits in total have gone into the protocol, and I care about how much loans have been given out to people. Like those are the real metrics you want to track, right? So like TVL is actually meaningless, right? Like if people were taking out more loans from Compound right now, but the deposits stay the same, then like in theory TVL would actually be decreasing, even though like the fundamentals of Compound be improving because it's like actually taking out like more loans. So that's like one. Two, it really depends on like how the protocol is accruing value from it. So let's say like Yearn's $4 or $5 billion TVL, I think it matters much more than if say like I don't know, Uniswap had $5 billion TVL, because Yearn is directly monetizing that TVL with like a management fee. So like at $5 billion, it's getting a 2% fee. Like that's actually like real fees that it's getting like every single year, just because it has that assets under management, right? Whereas with Uniswap, it actually take those assets and actually make them productive, right? By making markets with it. for DEXs, right? That metric is actually becoming less and less and less relevant because DEXs are becoming more capital efficient, right? So for Uniswap V3, you can facilitate the same amount of volume as, say, Uniswap V2 with like a fifth of the capital right now. So if like you had Uniswap V2 fork, which had $5 billion in TVL, and then Uniswap V3 had $1 billion in TVL, and you only look at TVL, you assume that the fork is doing better, right? But really, Uniswap V3 is doing better because it's like way more capital efficient. So the returns to LPs are actually like much, much higher, right? Because of that. Just to say, like around TVL, like the nuance there, and then, but I think that being said, like the way I've always thought of it is that despite all its flaws, it really is showing you like that people are entrusting like their wealth to a smart contract, and I think that is the most powerful part of it. Is that I shared yesterday that TVL hit like $150 billion in the world. It's like that's like nuts. Like people are storing $150 billion with like code, which is incredible. So that's where I think TVL shines best. It's just like taking it from like a global perspective. But when you start to go into like the individual details, like that's when I think you really have to like break it down.
The only point I would add is looking at incentivized versus unincentivized TVL as well. Because if a protocol is incentivizing capital into its protocol, then that is also less important because people are just allocating capital for the reward, as opposed to if there's no incentive, then that I think can be a meaningful metric.
We got to talk about NFTs. I almost laughed out loud at this question. Where do NFTs belong in a standard crypto investment portfolio? My answer is probably very different from your three answer, but maybe I just have less free time, or maybe I just don't get it and I'm a boomer. What's going on? Where does this belong in a standard crypto portfolio?
Yeah, I think they're emerging assets, and some will be very unique in terms of what they provide. So you have standard NFTs that could be like art, and I think art belongs in a large investor's regular portfolio in the traditional sense. And so there's no reason that digital art can't be in an investor's portfolio in crypto. And then I think there's other assets that if you're uniquely qualified to invest in, say that's like Sorare cards or NBA Top Shot collectibles, that can totally be a part of your investment portfolio. But I would caution anyone who's just going to buy like the newest hot NFT avatar project just because they think that that should be in their NFT portfolio or their broader portfolio in general.
I did that and I got burned. So I went into the FOMO of JPEGs very soon and very quickly realized that it's not the asset that I want to be trading.
Yeah, I mean,
Watkins, are you a blue chip guy?
No, so like so I'm definitely like the guy in the middle of the IQ bell curve when it comes to I think NFTs oftentimes, where I'm just like, all right, some of this stuff is just so stupid, but a lot of people are making money from it. But I think where I am right about it is here, where it's like right now, like clearly like NFTs are first of all, I think I hate the name NFTs as a category. Like that's like getting excited about ERC20s. And I think when people refer to NFTs right now, people just talk about collectibles and digital art. It's basically what people are getting excited about right now. And to me, like that's like a small subset of what's going to be the most exciting applications of NFTs in the long term. But that being said, just focusing on digital art and collectibles right now, to me, it just reminds me of like Ethereum in 2017, 2018, where I think the value proposition of NFTs is so clear. Like I said, as like a token standard. But like the application of it right now is just kind of not there, right? Like just like how in Ethereum in 2017, it was literally only being used to just raise a ton of money for projects that were vaporware. Right now, like NFTs are in often cases outside of like the blue chip, like CryptoPunks and Autoglyphs and guys like that. It's just being used to just like mint like stupid animals and other things. Like it just doesn't make any sense. And it's just used for speculation. So yeah, I think it's definitely like early in the sense of like we're not truly getting like the benefits of like this technology and really speaking it. But at the same time, like I think it'll probably progress along much quicker than obviously Ethereum did from 2017 to 2021. I think it's like 4 years for NFTs to have breakout applications. I think they already are in some cases. It's just what gets the most attention is just like the penguins and rocks and things like that.
We'll take a quick break for lightning round of comments, and you can chime in with your hottest take if you agree or disagree with me. Mohammed asks, will Ethereum reach 5 trillion by 2030? Maybe a better question is, what is the over-under for Ethereum by 2030? And I want to see what this small panel's prediction market is, and we'll see how right we are in 10 years.
What's the number? 5 billion?
5 trillion.
Will that
5
be like
trillion.
45K ETH or something like that? By 2030?
Mm-hmm.
Yes, it's going to happen. Long shot.
I don't know. I feel like if ETH is still around in the dominant platform by 2030, then I think that's possible.
Yeah, I put it at 6.
10 years is a long time. Like
Yeah.
either ETH's still here or it's not.
I'd say 60% chance.
60% chance.
Yeah, I'm going to have to be like closer to the...
You're going to get new followers for that one. Just utter certainty, 60% chance.
Wait.
Nothing could slow Ethereum down.
But here we go. So I'd say
you're here first.
There's a I think there's like a 60% chance that the winning smart contract platform is worth $5 trillion at that point. I think there's probably an 80% chance that is Ethereum. So whatever 80% of 60% is what it is for Ethereum. Yeah, that's a better answer.
I think you're all wrong because the correct answer is infinity, because the dollar gets progressively debased and declines to zero. We're not going to be denominating things in Ether anymore. It'll be in Bitcoin.
Quick question on that. Can I just ask, do you think that the U.S. Dollar loses reserve currency status in the next 30 years?
In the next 30 years, yes. In the next 10, no.
Hot take.
So hopefully,
no probability, huh? Just binary, yes and no. Okay, yes. I like it.
Yeah, it's gonna happen in 2037. I'm a time traveler from the future. So that moving on, I think I want to answer just a couple of logistical questions and then save 15 minutes or so for regulatory discussion of all flavors, because there's a few questions in here that pertain to regulation. So first and foremost, Pierre asked, what knowledge level do you need to get the most out of our Mainnet conference? Is this going to be beneficial to non-technical people fairly new to the sector? Yes. And Mason hinted at this a little while ago, or one of you guys did. That's the learning curve is steep, but it tends to work out that people that learn about Bitcoin learn about Ethereum much more quickly than they did with Bitcoin, and then they go down the rabbit hole to DeFi and all the other applications much more quickly beyond that. So the framing of Mainnet is very much focused on what are the applications, protocols, assets that matter beyond just Bitcoin and Ethereum. And that is going to be a pretty healthy mix of Web3 protocols, NFT infrastructure companies, DeFi applications, Layer 1 and Layer 2 platforms, and will be a really good 101 overview to the space and give people a good solid foundation that have at least a basic understanding of Bitcoin and Ethereum. But there will be some technical presentations. I would say the majority of the crowd is going to have options for more financial oriented and high-level oriented understanding of some of these new communities. On the platform side, Gil asks, are you going to add security tokens to our database? No. Are we going to, there's another one that I really liked. What services or products are going to bring the everyday person to interact with cryptocurrencies? This is something else that we're going to be spending quite a bit of time on, usability at Mainnet and actually giving people the opportunity to play around with some of these applications themselves and really have an excuse to, over the course of 48 hours, go booth to booth roll up your sleeves and actually experience the magic for yourselves, instead of just reading about it and speculating through an exchange. So should be a good learning experience there. And I would pose the lightning round question to wrap up until we get to the regulatory conversation to you guys. One breakout application that helps bridge the gap between the early adopter crowd and the innovator crowd, because we're still, or the early majority crowd and the early adopter crowd, which is the chasm that seems like getting close to crossing, but I don't know that we're there yet. Any ideas? Is it going to be just penguins and rocks?
Hopefully not. I am pretty excited for, I would say, the sports applications of crypto, just because I think that's something that has a lot of, let's call them like unrelenting fans. And I think they will do anything to speculate on their passions. And when you develop actual games based on those crypto applications, whether it's So Rare or Top Shot or Zed Run or you name it, that can be incredibly powerful in terms of mainstream adoption.
I can't really speak for everyone in this case, but at least from my conversations, when I try to explain, the concept of what crypto is to people, the one that seems to resonate with most people is this idea of helium, like having a router and providing the service and getting paid in helium for providing this service to a wider network. And that one seems to be like, when I explain it versus when I explain Ethereum, that one seems to like work a little better. So it might be that one. I'm not exactly sure.
So I think it's either probably going to be something like Axie Infinity, like a play to earn thing, where now anyone in the world can produce or basically generate income from this crypto economy, which I think is powerful because it's fun, and then it also just provides economic opportunity to people. And if it comes from DeFi, I mean, beyond just like the killer use case of speculation, which is just like trading and doing things like that, which I think we all love to do. It's probably going to be something really simple, like some kind of high-powered savings account, honestly, where people can just trivially deposit their dollars into, whether it be Compound, Aave, Yearn, and just start earning yield that's higher than their bank account. I think would probably be like a pretty killer app.
I've been pretty outspoken about the regulatory and political environment the last couple of weeks with the infrastructure bill, but I got to take a back seat first for a change and see what y'all have thought about with respect to potential risks to DeFi, to Ethereum, to Bitcoin that you see on the political and regulatory horizon. Given we saw in Q2 especially a lot of FUD. That ultimately corrected the market. We've come back, but lo and behold, last weekend we have a pretty major setback in the political conversation, at least in the U.S. So, what is on your mind right now as you're peeking around at different assets and different communities for potential risks when it comes to stroke of the pen in D.C., Europe, or really anywhere across the globe for that matter?
So I think for when it comes to just like so I'll bring this on into regulatory and then just like politics, just like people's positioning like on like these assets, which is more just like opinion based. So when it comes to politics, I think for Bitcoin, so I don't think Bitcoin there's any regulatory risk. Same thing with Ethereum. I think it's more around kind of just like how it is positioned among people in politics. And I think the biggest risk for Bitcoin is that it's around like the environmental framing of it, like it's like damaging the environment and things like that. I think it's also potentially Bitcoin being framed as like, or being politicized as being like a product of a certain political ideology and people being antagonistic against it for that reason. I think it's probably like a political risk for Bitcoin more specifically than say Ethereum. As far as regulatory, I think it's definitely squarely in the domain of really just DeFi. And I don't think that's something that will be as important anytime soon, I think, as most people. I think that stuff just takes a really long time to play out before it starts to matter. And I think finally maybe stable coins. I mean, that's just it's always just been a kind of like a hot button issue for regulators. I think everyone likes to talk about like Tether. I guess maybe for me, I think it's probably more likely that the U.S. ends up embracing projects like Circle's USDC rather than actually hammering down on it, because I think it'll be the easiest solution to kind of roll out a basic CBDC if you just like allow the private sector to take that mantle. And two, it's actually proliferating the dollar across the world easily, right? Like that's literally what it's doing. And it's also extremely surveillable, which I think they would like. It's easy to be controlled, which I think they would like. So I don't see why it's actually a bad thing at all. So yeah, I guess that's my position on stablecoins. I think it's a little bit different from like they're just going to crack on everything and launch a Fed coin. I don't think that's likely.
I echo the stablecoin point. I think it'll be much easier to adopt existing stablecoins like USDC and just kind of roll those into a stricter regulatory environment with greater scrutiny. That could be itself like its own political Supreme Court battle if Coinbase and Circle decide to like push back on any of that. We'll see if that actually happens. And then I still think one of the biggest risks in terms of regulatory environment is the various projects being labeled securities tokens, and then that being off limits to either US investors or non-qualified investors, or just hammering down projects that are otherwise decent, but just allocating airdrops to community members. And that could, I think, face pushback if a project maybe steps on the wrong feet. And so I think those are the two biggest risks that I see. I'm less concerned about Bitcoin or Ethereum in that regard. I do think that the ESG narrative is important and that Bitcoin will have to deal with that and make a strong push towards renewables. Otherwise, it will, I think, impact, at least in the short term, its adoption amongst institutional investors.
Yeah, I think that last point that you brought up, Mason, is what I see as my biggest concern is what is being labeled as security, what is not being labeled as what is security, what is not security. And I think, if I am by no means an expert in this area, so I naturally, my logical conclusion is that DeFi would be the one that is targeted here the most because of its proximity to financial services. But those were my 2 cents in this topic.
We have a few minutes left, and I think on the regulatory front, the biggest issue right now might not be Bitcoin, at least today, because Bitcoin is pretty properly decentralized. It's regulated by the CFTC, or at least the derivatives are. It's generally been treated as some combination of commodity and property, but not a security. Ethereum may have skated by with their 2014 token sale, just because it was so early, and now it is decentralized. Both might have other narrative issues that they need to confront with over time. But to me, it seems like the biggest risk right now is in DeFi, and ultimately how the regulators are going to try to consolidate authority or kind of crack down on the decentralization of banking and lending and all these other applications. What do you make of the new permissioned institutional DeFi protocols, right? So, what Compound Treasury is doing, and Aave Pro, and what I'd imagine will be a greater trend towards creating a, almost like a two-tiered system, one that is kind of fully operational and interfaces nicely with regulated players, and then the more Wild West component of those protocols. Will that happen at each protocol? Will we start to see more CDFI? How does this play out at scale, knowing that the regulators are finally paying attention and they're actually awake to the disruptive potential of these tech stacks for banks?
I think I was on mute. So I think it's very unclear how, because I think one of the problems with DeFi, so most DeFi protocols are just like pools liquidity, and when you're say like trading, or let's say you're trading on Uniswap, you don't know who your counterparty is. Your counterparty is just like this pool. This pool can consist of, I mean, tens of thousands, not hundreds of thousands of individuals all across the world who are providing liquidity to that pool. So in that case, like, how do you know that you're not like interacting with some terrorist? Like, you don't. So I think that's like the biggest challenge, and I think the biggest uncertainty, at least for me. And that's the reason why I think some projects are deciding to go like the permission pool route. So they can say like, okay, like we know that everyone who is depositing into this pool is a known counterparty. So like you actually know who you're trading against. I think while that is definitely like a pragmatic approach in the near term, I actually don't think I'm that bullish on it, because if that indeed becomes like what DeFi is, then DeFi has failed, right? You're literally, there's no difference between that and, say like Coinbase launching some smart contracts on Ethereum and saying, hey, this is Aave Pro, right? Like that's basically what it is to me. And if it starts to fragment like that, then, the Gen pool, which is like the one where it's Wild West and you don't know your counterparties, I feel like it will almost be like shunned upon to like use that pool to facilitate any kind of financial activity. And I don't think it works, right? So I guess maybe that's why, and also I really like both Aave and Compound, but I think in particular that's why I like Compound's approach to the treasury, where all that institutional liquidity is still going into the same Compound pool that everyone else is in. It's just that they're just going through a kind of more buttoned up funnel, right, where they are doing the KYC on these customers, and it's just making it easy for them to deposit in there. That's how I see it now. So I guess kind of uncertain. We'll wait and see. I imagine that Compound is they have some pretty smart people there on the regulatory and legal side, and I imagine that they're not pursuing that path without having some kind of confidence that'll work.
Yeah, just like that, because I'm very excited to see protocols. Unlike, I think I'll play the devil's advocate on your statement, Watkins, with them failing if they go that route, purely because I don't even if there is this permission pool in other Compound, the protocol itself is still permissionless. Anyone around the world can still access and can still borrow and deposit in this protocol. So on that end, I don't think it entirely fails. And I'm just very excited that Compound with Treasury and Aave with ARC are moving in that direction, trying to hit that part of the market, because I imagine eventually it's going to happen, and it's good to see at least some evolution in that direction.
Yeah, I think it's a good Trojan horse. And honestly, I put the impetus to eventually transition that capital onto the individual community members. You're going to have to make the yield more desirable to the institutional investors, and you're going to have to increase the value to the actual permissionless side of the protocol. And I think if you can do that, then eventually you will accrue the capital out of the KYC institutional pool.
But here's the thing with like these institutional pools is that they are far more likely to attract far more capital than these retail pools. I mean, don't get me wrong, like DeFi has been successful, but $10 billion or $24 billion in deposits in Aave is like a drop in the bucket in the grand scheme of the financial system. Like the institutions that are being depositing liquidity in the future, they're going to take this stuff to trillions of dollars eventually.
Right,
and if that's the case, then like that and if there's $1 trillion in this permission pool, like to me that just like that means that we failed.
But will something like Yearn be able to leverage an institutional pool? Like, will that capital be locked in the institutional environment, regardless of what DeFi protocol it's interacting with?
Well, I mean, I don't know. Like, they would have to like KYC like Yearn the protocol. I don't think that's possible.
Right, and so I think there's going to be natural network effects and advantages to the permissionless side of things that, in the long run, should win out.
The real question, though, is when will we see institutional pixelated punks and JPEGs?
Soon, TM.
Soon TM. That's as good a place as any. Buy your punks as fast as humanly possible. Doesn't matter how much they cost. That's the financial advice that we're giving to close things out, correct? Number only goes up. The floor only goes up. Buy rocks, buy punks.
Penguins.
And just make sure you diversify into penguins if you're too heavily overweight punks.
Please don't.
Everyone, thank you so much for joining us today. Hope to see you all at Mainnet in just 5 weeks. 5 weeks from yesterday, actually. So it's going to be a phenomenal event. We've got over 100 projects represented, close to 200 speakers. Should have a couple thousand folks there. It's going to be the event of the year. We'll see if DevCon actually happens. Unfortunately, I would take the under on the probability that happens this year. So if you're looking for big fall events with all of the movers and shakers that you haven't seen in person in a long time, check out Mainnet 2021. Use that discount code. Bailey, what is it?
The discount code is Mainnet AMA. So I'm posting the link again here in the chat. And then also, if you want to wait a couple days to grab your pass, which I don't know why, like Ryan said, it's going to be awesome. But if you do, you can use the discount code at checkout, Mainnet AMA. So that's there in the chat. Yeah, thank you guys. That was a super fascinating conversation. People in the chat and on Twitter were loving it. So glad you guys could join us. And then just for the attendees that are here, we have another one of these crowdcast sessions. It's going to be on scaling and layer 2s, Ethereum specifically, but we might cover some layer 1 stuff as well. So that is August 31st, and I think it's also at 1 p.m. But yeah, just sign up for that as well. All right. Thank you. Bye, everyone.
Terrific. Thank you all.